Our focus on business today is from America, and the US Treasury has reported a major jump in customs duty collections for June, pushing total gross tariff revenue past $100 billion in the current fiscal year, a first in American history.
Starting in the United States, where the White House has announced new tariff rates for dozens of countries that have not yet reached a trade deal with the United States.
A new report from the Federal Reserve Bank of New York finds that Americans are bearing nearly all of the costs of Trump's recent tariff hikes. The study estimates that nearly about 90% of the import taxes are being paid by the American consumers and businesses.
In the most recent fiscal year, a record number of American importers have run into a serious financial problem connected to United States trade policy. New data from U.S. Customs shows that in fiscal 2025, there were 27,479 customs bond insufficiencies valued at nearly $3.6 billion. This means that importers coming to U.S. ports with goods owed more in tariffs and duties than their financial guarantees could cover. These numbers are the highest ever recorded in the history of U.S. Customs. What we are seeing now is more than double the level of bond shortfalls recorded in 2019. Those earlier shortfalls also happened after tariff increases from former President Donald Trump's policies. To understand why this matters, we need to explain how tariffs and customs bonds work together in everyday trade. When a company brings goods into the United States, the importer must buy a customs bond before their cargo can be released from the port. This bond is a form of guarantee required by U.S. Customs and Border Protection. It acts like a financial safety net, promising the government that the importer will pay all duties, taxes, and fees owed on imported goods. If the importer fails to pay, the bond ensures the government gets its money. Customs bonds are issued by surety companies, which are similar to insurance companies that specialize in this type of financial guarantee. The importer pays a premium to the surety company based on the size of the bond. Customs bonds are not a fixed amount forever. They are calculated based on how much duty and tax the importer is likely to owe over a rolling 12-month period. If the total liability goes above what the bond guarantees, Customs issues what is called an insufficiency notice. Trade lawyers and experts say the root of this problem is the increasing tariff rates that were enacted in recent years, especially those tied to tariffs from President Trump's administration. These tariffs apply to imported goods from many countries and are often far higher than normal customs duties. In some cases, tariffs can add 10%, 25%, or more to the basic duty owed on goods. Because customs bonds are calculated based on what importers are expected to owe in duty over a year, any rapid increase in tariff rates can quickly overwhelm a bond that was set up under lower duty levels. When a company is notified that its bond is insufficient, the first immediate consequence is that goods are held at the port. These shipments, often full of products waiting to be sold or used in manufacturing, cannot move until the importer increases the bond amount. That often requires working with surety companies to get a new bond written or to post additional collateral, such as cash or letters of credit. Collateral is money or financial assets pledged to support the bond, and it can be held for as long as 10 months or more. During that time, the importer cannot use that money for operations, expansion, or other business needs. Higher collateral requirements tie up cash flow and make it harder for smaller firms to operate. Importers must act quickly when they get an insufficiency notice. The process of getting a supplemental bond or posting additional collateral can take 10 days or more. While that process is underway, dock storage costs and delays can add up rapidly. Delays in receiving goods can interrupt inventory schedules, affect production lines that depend on imported parts, slow retail replenishment before peak seasons, and disrupt just-in-time manufacturing systems. All of these consequences translate to real costs for companies and sometimes lead to higher prices for businesses and consumers. All of these consequences translate to real costs for companies and sometimes lead to higher prices for businesses and consumers. This rise in bond insufficiencies has been building throughout 2025. Data reviewed by some trade industry observers showed that bond shortfalls were already approaching $1.5 billion by the first 7 months of 2025, compared with about $546 million for all of 2024. This sharp escalation underscores the strain that rising tariffs put on the customs bond system, especially for smaller and mid-sized businesses that may not have the liquidity or credit capacity to quickly raise larger bonds when needed. At the same time that importers are struggling with bond funding shortfalls, the federal government is collecting large sums from tariff revenue. Higher tariffs generally increase the amount of money customs collects on imported goods, and in calendar year 2025, the total tariff collections have been very high, with monthly tariff receipts sometimes topping more than $30 billion. These numbers show up in fiscal reports and indicate that tariffs are a growing source of revenue for the government. The contrast between rising government revenue from tariffs and the financial strain on importers highlights how the cost of tariffs flows through different parts of the economy. For importers, trade attorneys recommend that they review their historical duty payments and project future exposures carefully. Working with customs brokers or trade law professionals to calculate required bond amounts is seen as essential in this environment. Importers are being advised to secure supplemental bonds or necessary collateral earlier, rather than waiting until they receive an insufficiency notice from customs. Monitoring customs notices closely and responding promptly can help reduce delays and additional costs at the port. Trade experts, bond underwriters, and customs brokers warn that many companies, especially smaller businesses, were caught unprepared for the speed and scale of tariff increases. Some importers were using older formulas to predict what bond coverage they would need, and when tariffs rose faster than expected, those formulas became outdated. Surety companies that issue customs bonds also reassess risk, and in an environment of rising tariffs, they may demand more collateral before issuing higher bond amounts. This increases the financial burden on importers, particularly those without strong cash reserves or credit lines. The broader implications for the U.S. economy could be significant if these bond shortfalls continue or widen. Delays and increased costs to importers can ripple through supply chains, affecting manufacturers that depend on overseas parts, retailers who need timely product shipments, and even consumers who may see higher prices on imported goods. Higher tariff costs and the resulting bond demands can also influence business decisions about where to source products, shifting trade patterns over time. Some policymakers and legal experts are watching closely because legal challenges to certain tariff authorities remain unsettled. In particular, some tariffs were imposed under laws that are currently under review in U.S. courts. A potential Supreme Court decision on the legality of certain tariff authorities could affect future tariff policies, and if tariffs are rolled back or refunded, that could change how bond requirements are calculated and possibly free up collateral that companies have already posted. This record-breaking customs bond shortfall is a clear example of how trade policy, government revenue, and business finance are interconnected. Policies aimed at protecting domestic industries through higher tariffs can have unintended consequences in the financial systems that support international trade. Importers must adapt to this new environment with more careful planning, better forecasting, and closer monitoring of their customs liabilities. Government revenue may be higher, but for many companies, the cost of compliance has also grown.